Hello, I'm Stephen Hammond with Christian Values Investing. Have you ever wondered exactly who you're listening to? When you're talking to your financial consultant, your investment advisor, are they really working out for your best interest? Are they really competent? In the next few minutes, we're going to be going over some portfolios that we have moved over from some broker-dealers over to Christian Values, and I want you to take a look at them and you come up with your own opinion. Stay tuned. Today we're going to be going over some portfolios and what you should be looking for. I've got 3 different portfolios we're going to analyze, and they're all 3 are going to be mutual fund portfolios. They may have an ETF in 1 or 2 of those, but these are client accounts that have come over to Christian Values, and just wanted to show you what these folks were invested in at these broker dealers, and let you make up your own mind once we point a few things out. Was this advisor really doing this client a good job? The first one we want to look at is a copy of a Merrill Lynch IAP statement that we have actually used on Morningstar Advisor Workstation. We transferred all the account holdings over to Morningstar Workstation. If you're not familiar with Morningstar Workstation, it actually came out years ago, and it used to be called Morningstar Principia. When you had to have if you were going into litigation, if you needed an expert witness, and it's dealing anything with the stock market, a lot of times those expert witnesses would use the old Morningstar Principia. So what has happened here in the last 15, 20 years, a lot of advisors are using Morningstar Workstation, which is the same thing as the old Principia, and you can analyze portfolios. So the first one we want to analyze is something very similar to what you would probably see at something like a Merrill Lynch IAP, where you can invest in all different kinds of mutual funds and just pay a fee to do that. So what you see here is you'll look at, there's about 10 or 12 different mutual funds on this list that these people are invested in. You'll notice that if we go up, that the rates of return on this portfolio for the last 3 years, this is run from 5/31/2021 to 5/31/2024. You see right here that their gross cumulative return is negative 1.56 compared to 31.54 on the benchmark. So from that alone, you can tell that this portfolio hasn't done very well in the last 3 years. It's actually way underperformed the benchmark. But you could have mutual funds that make up a portfolio like this, and when the advisor bought them, they could be 5-star mutual funds, but had a bad time, a bad season, and they may drop to 4-star, 3-star, 2-star. But the returns you see on this portfolio have not been good at all. So let's kind of go down and look at a breakdown of this portfolio. You'll see that Brown Capital Management, small companies in here. You'll see Loomis Sales Growth, Morgan Stanley Institutional Growth, a Principal Blue Chip R6, and a Principal Mid Cap R5. You'll see their T. Rowe Price Mid Cap Growth. You see a lot of well-known names in this portfolio. You'll see the Vanguard Russell 1000, the Vanguard Small Cap Growth in this portfolio. But what I want to kind of get you to break down, you'll realize that this portfolio consists right here of about 92% in U.S. stocks and about 5% in domestic stocks and about 2% in cash. You would think that this portfolio should have at least kept up with the market. What you'll see, the top 10 holdings here are Microsoft, Amazon, Nvidia, Meta Platforms, Lilly. It keeps going down all the way down to Netflix at number 10. Another thing for you to take a look at that's very important is that the rates of return on this portfolio, you'll see the best percentage over the last 3 months, 1 year, 3 years, and the worst 3 months, 1 year, and 3 years. I want to scroll a little bit down further. This will give you a good idea how this portfolio ranks. You'll see where the standard deviation is 21.02 versus 17.81 for the market. So what this is this portfolio is more volatile than the stock market, but it hasn't returned the returns. And you see right here the alpha is negative 9.8, which is terrible, which shows that the advisor managing this portfolio did a very bad job because he wasn't value added at all. You see the beta was a 10% more than the stock market, so it had 10% more risk. But I want to scroll on down to show you the intersections between these mutual funds, and this is very interesting on how this works. It will show you stock intersection on these different funds. So out of these funds, you see 5 of them out of the 10 or 12 that was in there, growth have all on Microsoft. You'll see that 5 of them owns Amazon, 5 of them owns Nvidia. You'll see that 4 of them owns Meta, 3 of them owns Eli Lilly right here. You see Visa is owned by 5 of them. And so what you realize from this, you have a lot of intersection where you're thinking you got 10 or 12 different mutual funds, but they're invested in so much the same stuff, you're really not anywhere more diversified as if you held just one of those mutual funds. So that'll give you a good idea what you need to look at in a mutual fund. Let's go now to the second mutual fund that's been transferred over. This came over from A.G. Edwards, and I wanted to show you kind of where we're at with this portfolio when it came over. This portfolio did a little bit better than the last portfolio, and the reason why this one was diversified a little bit more out into bonds. You know, we've had 2022 was a bad year in the market, but it still wasn't very good. What you see here is its gross returns were 8.74 compared to 31.54 for the benchmark, which is a net average annualized return of only 2.44%. Now, if you go back over the last 3 years, you could have got a CD that would have generated a greater return than this portfolio. But let's go down and scroll down through it and let's take a look at it. You'll see from the very top that this fund consists of some American funds. The Fund of America is one of them, and the Investment Company of America is the other. It's got also a Growth Fund of America. It's got a Bond Fund of America. It's got the Hartford Dividend and Growth. It's got the J.P. Morgan Core Bond, Lumisel Investment Grade Bond, and it's got the MFS Growth. So when you scroll down and look very closely at this particular portfolio, you'll notice that this portfolio has a little over 1% in cash. It's got a roughly 55% in stocks, which consists of 46% in U.S., 9% in foreign stocks, and actually 43% in bonds. So it's really close to a 60-40 split. As we scroll down, we'll see that the portfolio, let's look and see what we can find on the returns for 1 year and 3 years. You'll see 10, 15, and 2%. The worst was actually from October 21 to September 22. This portfolio was down 14.54%. Let's scroll on down and get a little better snapshot of this portfolio, because I want to show you the alphas, the betas, this type stuff on this portfolio. You'll notice on this portfolio that the alpha is a negative 4.21. It's got a beta at 0.57, so it's about 40% less risk than the market. You see the standard deviation where it's less than the market. This portfolio has gotten clobbered by the benchmark, but it was a little bit better than the other portfolio that we looked at. But you go back and you look again at the portfolio intersection, and you're going to see that there's so much overlay in all this. So let's look at this. Out of these funds, the Microsoft is actually held in 5 of these funds, NVIDIA 3, Amazon in 3, Meta Platforms in 3 different mutual funds, Apple's in 5 different of these mutual funds, Alphabet's in 4 of these, Broadcom is in 2 of these, and Visa is in 2 of these. So what you're having is an intersection where a lot of these funds are holding the same exact company. So this person is probably not as well diversified on the stock side as they originally thought with this many mutual funds. Now, the last one I want to look at, this actually came over from Ameriprise. And what you're going to see is that compared to the benchmark at 31.54, the net cumulative return is 1.45, but the gross cumulative return is 5.09. You're saying probably, how could the net be so much less than the gross? And the reason being is all these funds that we're about to look at are from the same fund family, and they're all upfront sales loaded funds. So let's scroll down and take a look at these funds. They're all Columbia funds. The first one is a Columbia Balance Fund, Columbia Dividend Fund, Income Fund, Quality Income Fund, Select Global Equity, Mid-Cap Growth, and the Mid-Cap Value, and the Strategic Income. Now, all of these funds are Columbia funds, and you'll look down at the breakdown. It's about 55% in stocks and about 40% in bonds and about 2% in cash. This portfolio, if we'll take a really close look at their worst time, 1 year they was down 18.24%. Best 1 year was 15.99. The worst 3 years at 1.67. The best at 1.67. So those kind of balanced out. But I want to come down and show you that the alpha on this was negative 6.03. It's got a standard deviation of 12.9 versus 17.81 on the benchmark. And the beta measurement of risk is 0.7, which is about 30% less than the market. Now, when we scroll down and look at the intersection of this, you'll notice there's, even with almost a total split between stocks and bond equal weighted, the equity portion, the stock portion, there's a pretty broad intersection. And you're going to see Microsoft was in 4 of these funds, NVIDIA 2, Amazon 2, JP Morgan Bank 3, Apple was in 1. Visa was in 4 of these. So what you're finding out is so many of these portfolios, there's an intersection where a person is not as well diversified as they thought. But this particular account that came over from Ameriprise, why would anybody that's trying to work in the best interest of their client invest in every fund in one fund family? And I know some of the broker dealers that's maybe listening and saying, hey, they can get a break point on upfront sales loads, but why don't you just go out and try to find them the best funds in each category? If you can't pick stocks, if you don't know how to pick stocks, pick the best funds in each category and put the investor in those type funds, and make sure that you don't have too much on intersection, and actually have it where the portfolio as a whole will fall in the right risk category for the client. But go back to the original question, who are you listening to? These 3 people that came over thought that they were listening to someone who was looking out to their best interests, who was competent in the industry. But as you can tell from this, that leaves a great question. Were they really looking after their best interests, and are they really competent in what they do? Until next time, God bless you.